Welcome to the start of our second season. This is the first episode of the second season of the AUTOVATE Podcast. And thank you for joining us today. My name is Cliff Banks, the founder and host of AUTOVATE. We launched 8 years ago and was the auto industry's first and only event focused on investment in the automotive retail space. Today, we have newsletters and our podcast, of course, in addition to the event, which is still going strong. We're busy putting together this year's event that will be held the first week of December in Scottsdale, Arizona. So put that on your calendar. We'll have more information in the next few weeks for you regarding registration and agenda. Also, if you haven't subscribed to our newsletter or podcast yet, you can do so at autovate.org. Our podcast is on YouTube and Spotify, so feel free. You can also find the AUTOVATE podcast on those channels. I also want to let you know today's episode is brought to you by DAS Technology, a leading consumer data and experience platform, also known as CDXP, that enables over 9,200 dealers and retailers and OEMs across 34 different countries to communicate in new ways that increase consumer response and lead conversions. Leveraging their patented AI-powered digital technology, DAS generates measurable ROI by helping businesses respond faster to consumers with meaningful information that helps them want to do business with the retailer. Now, the DAS is also a pioneer in digital response. They deploy omni-channel messaging, mobile apps, software, and consumer engagement technology to monitor, respond, improve, and convert more consumers into customers for businesses in the United States, Canada, and like we said, 32 additional countries. Okay, now let's get on to the episode. Joining us today is James Taylor. His friends call him JT. He's a managing director for Automotive for Truist Securities. Welcome, JT.
Cliff, it is always a pleasure to hang out with you. I learn so much every time we do.
Right back at you, brother. Right back at you. So a lot going on, obviously, in our space. We seem to be right now no let up on the dealership M&A activity from what we've seen the last couple of years. And just to kind of give an idea to our audience, I think from 2013 to 2019, the average number of transactions in our space regarding dealership buy sells was around that 350, maybe a little bit higher mark. Actually, that was the number of rooftops. The number of the average number of actual transactions ran about 220, and then it took off towards the end of 2020 during the pandemic. I think led off by Asbury's acquisition of the Park Place stores in Texas. And then it was off to the races after that. Now we're talking 650 to 700 rooftops with close to between 300 to 400 transactions the last couple of years. Are we seeing the same thing this year?
Oh, I think so, Cliff.
Yeah.
And there's a couple of things that are driving it today. It was, peak earnings and peak value. But, when you translate those earnings into the enterprise value, that caused a lot of people who were giving consideration to it in the past to make the move. And it was great timing for a lot of great dealers to do so. Today, still a lot of great dealers out there, still a lot of appetite for growth. But there's a bit more caution about values and about approaches because there's a significant increase in cost of capital. Nobody writes a check out of their checkbook for these deals. They've gotten very expensive, and they use their banking partners in order to do that. We'll talk about that a little bit later about those structures how they're shaping up. But there's still the desire. It's just a little bit more caution. What's pressuring it though is the other side, the number of sellers that have come to the market. Two things are pushing that. It's the calendar. We don't change that. The boomers own car dealerships. Boomers are aging out, and not just the owners, but also those operators who they've stuck with and built great businesses with, there's a desire to retire that is part of this trend towards greater consolidation, particularly of 1, 2, and 3 point businesses. When I say points, 1, 2, or 3 rooftop businesses.
Right. Yeah.
And then there's kind of a little emotional thing going on, the FOMO thing, fear of missing out. My peers are leaving, and they peers, it looks like they did it at a good time to do it. And I'm hearing good reports from my peers who have left the business that there is life after automobile sales. And the hands have come up.
Well, it's interesting you say that, because I have had this conversation. I've been having it for about 5 years with dealers, wanting to know whether it's time they should think about getting out. Often it's the second generation of the owners, and it's the sons or daughters who have asked me that question, and my answer has changed from 5 years ago. I think today I'm telling anyone that asks me, I would sell. I would have sold already right now. Take the money. It's like winning the lottery. There's nothing keeping you from getting back in the industry or getting back in as a dealer. There's nothing keeping you from carving out a brand that you might like. If there's a high level brand you like to play around with, there's nothing keeping you from holding on to a store or two. But take the money now. It's like winning the lottery, and you're de-risking. What the next, what could be going on over the next 5, 6, 10 years.
Those are very interesting points. And even though there are a number of us that have either taken advantage of that or have been speaking to that for that same time period, most dealers just haven't heard it. You mean I could get somebody would be willing to be my minority partner in my deal, and I could take some money off the table, and then we could, if we want to grow, we can. If not, we're just, writing, distribution checks to each other. Yeah, you sure can. You can take money off the top, out of the business, right at the top of the market, and go forward. Now, that's not an opportunity that's available to everybody. Typically, it's dealers of scale, 5, 6, 7, or larger rooftops. But on the other side of it is also the fact that the values have never been higher. There's been a wonderful increase in efficiency in most of our operations. Some people still aren't paying attention, but they've gotten to be pretty few. The issue that I think faces most people about the daunting part of this is they don't know what to do. It's not ever been in the consideration set. Now it's in the news every day. Someone else is exiting. That has been, you've done a great job of educating the industry through the Banks report, Cliff, about, what that activity in auto retail and auto tech really looks like and what it could mean. But the reality is most folks, until they come upon something that they don't really know is going to happen, like electrified vehicles,
right?
The threat of maybe not a genuine threat, but a apparent threat of a new car sales being guided by an agency model, as opposed to your traditional franchise system and sales and service franchise. It's really difficult still to read the market and to make strategic decisions about what your future is going to look like. Dealers are awesome at the tactical. Oh my goodness, they know how to lay out the day. They know how to lay out, the hour even in their operations. They're great at it. But when it comes down to and are comfortable reacting to the market, but forecasting and then including what is best for them as the shareholder has kind of become a new thing. And that's giving the more sophisticated advisory firms like Truist Securities the opportunity to talk into what does it look like? What are your genuine options as an owner of a car dealership or a car dealership group?
Let's walk through some specifics, and we don't need to obviously name dealerships, but what are some ways in which you structured a deal? You see deals that are being structured in terms of either an investment, taking money off the table, or an outright acquisition. Walk us through what that looks like.
Well, I think one of the things, Cliff, that we always try to advise our growth-minded dealers on is, do you know how to buy a store? And let's flip the coin. What's your store worth? And let's do that study for you so you can see where the values are out in the marketplace, so you can make good decisions about an acquisition and a target. And front and center, of course, is available capital. In the banking world, they call it debt capacity. How much could you borrow, still be able to sleep at night, and put to work in an acquisition? And then how much do you have in your pocket or available to you, in cash or equity in your business that you could translate into purchasing another one? So you got equity and you got debt,
right?
And you put those together, and it gives you that shows you the size and the value of the opportunity you can pursue. Dealers are typically pretty surprised about how big a business they could buy. Then, of course, they're typically surprised about how expensive they are. But that's not the issue. The issue is, can you buy it? And can you meet the value? A lot of dealers are looking today and saying, hey, I've had a great run here these past 5 years. The next 5 years don't look that bad for a lot of great reasons. My business has improved operationally, and I'm comfortable with the market. So let's take a look at growth. I'm going to talk to my lenders first and say, what can I do? How far is up for me? That's a good answer that question about your debt capacity. The structures, though, are traditional. And I'd say traditional, and a lot of dealers don't necessarily haven't done this, so they don't know. When you agree on a value of blue sky or goodwill value for the business, then you have working capital, assets, and cash that has to be in the business. That number combined in your acquisition can be financed up to 50% in a traditional fashion. Most lenders who do this type of business will advance you 50% of the goodwill and the working capital assets that you need in order to operate the business. And then there's that wonderful third leg that a lot of dealers have a great understanding of, and that is real estate.
Right.
And typically, banks are going to loan you an advance of 80% on that value, appraised value of the land and building. So I've got to come up with 50% of the capital out of my pocket for the blue sky and the working capital, and 15 to 20, usually 20% of the value of the real estate. And that way, you can figure it out. You can back into that pretty quickly. Keep that number in mind, because we're asking dealers also to do something else. When you take your pro forma that look forward at your first year or first 2 years of owning and operating that business, how well are you going to do?
Right.
You lay in your debt service, and then you take what's left, your earnings before taxes, and say, okay, I put in 10 million. My earnings before income tax my first year is 2 million after debt. So what's my cash return on the first year? 20%. 20% tends to be kind of a rule of thumb for dealers. Now, keep in mind, and you know this as well as anyone else, risk-weighted returns are a big part of our business. That's why there's brand multiples.
Yes.
A Porsche store, a Lexus store, a dealer may be willing, a buyer may be willing to take a 10 to 12% return, cash return in the first few years in order to secure one of those scarce and very valuable franchises.
Right.
The volume franchises where there's a lot more of them out there as well, probably less so. But once again, that 20% is kind of the rule of thumb. That's If you had a bell curve, it would be right in the middle.
Yeah.
Expected
Yeah.
returns from that franchise. Now, let's say we're scaling. We've got 7 stores. It's been we put them together over the last 12 years, 14 years, my dad and I. And now Dad's stepping aside, but he's taken care of, and I've got an opportunity to double my business because there's a 7-store group down the road that is raised their hand and they want to sell, and I think I can buy it. Go to my bank, we find out we can, but the bank tells them this: you can buy it, and the numbers work under those leverage ratios that we just talked about, but no one bank is going to give you all that money.
Right. So you need to go to multiple. Or this is where someone like you comes in.
Exactly. And
correct. And helps.
Yeah. When you have a multi-bank lending structure that you're able to use, there's a lot of advantages to having a bank like Truist organize them for you, the agent. They call it lead in the finance world. So you've got an agent bank that you trust, and they invite other banks on the basis of your plan to buy these other assets, these other stores, into the group. And you end up with a group that can grow with you. Because frankly, after you bring in that 7th store and you get real comfortable with it, it's 3 years later, I'm at 14 stores. I could maybe do this again. I could buy 10 stores and be at 24, 25 stores here within 5 or 6 years. And I don't have to go back and do this exercise again. I pick up the phone or visit again with my agency bank from my syndicated loan structure, and they go back to the member banks and say, hey, here's the next acquisition. Here's your share. And everybody comes back in. As long as your earnings on a go-forward basis fall within the ratios. Here's the ratio in those large groups. Your leverage, by the way, floor plan is never counted in this amount. It's acquisition debt, term debt, and your real estate debt. And you add your term debt and your real estate debt together, and typically you can have 2.5 to 4 times that amount of EBITDA that you generate. So I cash flow at $30 million. I could get up to $120 million of leverage on my next deal.
So there's a lot of wiggle room for these groups that are looking to. I mean, and being able to do it with quote unquote other people's money. I mean, obviously you got to pay it back. I mean, from a loan perspective, but
a lot of different ways to do that.
Yeah, let's talk a little bit about just the whole investment thesis. And for years, there's always chatter about the private equity getting in to this industry, and we've seen some. We haven't seen a lot. We've seen some, and some have been very successful. The Jordan Company,
great example,
PE firm out of New York with Rick Ford, putting together a group, growing a group, and selling it a couple of years ago to Sonic for $950 million. We see the cousins, Jim Davis and Steve Bisciotti, up in Maryland, who have invested in a couple different groups and an RV group. I think they're financing the whole Morgan expansion, which is going like gangbusters. I mean, every few weeks you see them buying another store. And then also the Dave Hudson's group in the Southeast area. That looks to be a play that could be, that's more or less of a family office, less of a private equity play, I guess, but it's still private equity. And then we have franchise equity partners, and then some other players, Open Road, that are doing something similar, which are investing in stores, not buying them outright. Are we getting to a point where we're going to see more of this, or is it still a challenging pitch or sale to make to private equity?
Private equity, as for the last 30 years, has existed on, the primary focus is buy it, grow it, sell it. And the shorter amount of time you can do that in, the higher turn rate you can have on the available capital and get the same returns that were not necessarily promised, but that were suggested to your investors, that's their goal. And that model is not a favored model by any franchisor. And in most, I mean, you and I both know these are local businesses, and they're high touch consumer businesses, and churn, typically in ownership, certainly management ownership, is kiss of death.
Yeah,
the consistency and the improvement and participation in the community are critical to these businesses. It's critical to the relationship between the franchisee, the dealer, and the franchisor, the OEM, the manufacturer. So private equity doesn't like that. And it doesn't fit. It becomes more.
Neither does the OEM.
People, exactly. The OEM doesn't like it, but let's just set that aside, because they adapted to public ownership.
True, they did. Yeah.
They highly value those 6 public dealerships
in the late 90s. Yeah.
But but private equity, I don't think they're not going to cross that threshold as long as they maintain a mandate in their funds that they aggregate, saying we're gonna take your money, we're gonna put it to work, we're gonna sell those assets, give you a return, redeploy your should you choose investments, and we'll do it again. And our franchise auto retail business doesn't work that way. So, however, what we're seeing are these hybrid models. You mentioned a couple that where there is a desire to see a willingness to hold for 7, 10, 15-year periods, or in the case of a family office, maybe generations.
Right.
Family office is privately generated wealth that is set aside typically out of the family's core business, or it comes out of the core business when they sell it, and they put it to work in other alternative businesses.
Right.
By the way, most family offices are managed and operated by ex-private equity people. So
there's an expectation on certain level of return, obviously, and
always
reporting and
now it's we talked about the return hurdle for cash on cash for a dealer buying a dealership.
Right.
Typically for private equity, the magic number has been 22. Don't know where it came from, but that's what the institutional capital, we're going to get a 22% return on that capital. Sometimes that's measured out over 7 years. Sometimes that's an annual return. Sometimes there's a variety of things, but 22.
There's different ways to get there.
Yeah. It's the number. But it's not so far off. That's not so different than what the dealer's expectations are.
Yeah, sure.
You know what, though? Despite people like you out there broadcasting just what great investments auto dealerships can be, and we doing that at our firm, we actually have, and you've seen it, we have a tutorial that we provide to private equity firms. Where's the value in an auto retail business?
Right. And
they look at it and they see it and they're intrigued. And then we step into the nuances of the franchise relationship. And it tends to get a little murkier for them. It's not as clear.
Suddenly they're not just having one partner, they're having 2 partners when you factor in that OEM deal.
There are and auto dealers, people who have grown up in the auto retail business, they understand that relationship. They value that relationship.
Right.
And most manufacturers value that relationship with the dealer as well. We do see instances where they get kind of mistreated, and there's sometimes even those that have great relationships are forced to do things that they don't want to do. Today, Honda lowered their dealer margin by 0.5%.
Today, yeah, they did that. I mean, they announced that in Canada a couple of weeks ago, and it was only a matter of time before we knew it was going to happen here. It's an interesting piece of news. I mean, I think that broke yesterday or today, but we knew it was coming.
It was, and I think that, it's also a recognition of something that every dealer knows is out there, because they're making the investments themselves.
Yes.
Electrified vehicles are very expensive to develop. And we're not there yet from a product standpoint, at least to satisfy the today's consumer behavior and consumer perceptions. And certainly from an affordability standpoint. We don't even know if EVs are that green from that standpoint yet.
Right. Sure. Sure.
There's a lot of discovery left, and that discovery is really expensive. And for
And it's going to take a few years
you,
before we have answers.
share a little bit more on your opinion on that. You and I are aligned on that, but go ahead if you don't mind.
Well, I just think we are we are in right now the greatest period of uncertainty in our industry's history. I think for years, I mean, centuries, decades, we've known, not centuries, but over the last century, we've known, we've had the playbook. In fact, when you look at some of the articles, headlines in the trade magazines of the 1920s, late 19 teens, early 1920s, sort of like in Automotive News or Awards or some of these others, it's uncanny. I mean, sometimes you could look at the headline and not know which century you're in, because they were dealing with some of the same problems and challenges that dealers are, business issues that dealers are managing today. But now I think we throw in that whole electric vehicle question, and we saw what the Biden administration did this week, and I don't think that was a favor at all. I mean, a lot of headlines are talking about it's a compromise or giving some more breathing room. Well, yes and no. I mean, that was not a good announcement for the auto industry at all. The EPA seems dead set on getting to their goals, whether the customer wants it or not. And I think we're falling into a area of state capitalism, not too dissimilar to what we see in China. Only I think China's managed it much more effectively the last 10 years than what we're doing, sadly. But so what I'm saying is we just don't know what the future, I think, is going to look like over the next 5 to 10 years, because we just don't know the impact that EVs are going to have if we even get there. And that's questionable, but if we do, it's going to challenge or change and upend a lot of what we know about the space, including how vehicles are valued, the valuations that we place on vehicles. It's going to change, upend the way dealers, businesses look in terms of service. There's a lot there, and then you have the Chinese question, and I think the Chinese question doesn't really impact dealers as much from a business. I mean, they can sell Chinese vehicles, and I think there's plenty of dealers that would jump at the chance to sell a Chinese vehicle that is brings in some profit into that customers want. So dealers will sell anything. It's the brand, the manufacturers, the legacy automakers, the ones that are probably more at threat there. But I think we are. To me, the uncertainty, and the dealers are being asked to spend hundreds of thousands, millions of dollars in investment on a future that is not certain. So,
it's akin to making these investments as a dealer today, particularly at the scale that you're required to. It's a pretty daunting decision. A lot of people are doing it because they've got the money after the golden age.
There's still disposable capital.
So we're gonna let's do it. Let's get ready.
Sure.
Cars are coming. Of course, now cars are being delayed, so I've got this passive investment that sitting here. However, I kind of compare it to I could have put a solar roof on my house 12 years ago, and it would have cost me 8 times what it cost me to do the same thing this year.
Yeah,
and it's 8 times as efficient, the product 10 years later. Right. So that is what we're going to face. The rate of obsolescence when you're in these early change technology,
sure,
is rapid, and it's expensive. And now the expense is being felt by the dealers. It's felt by the consumers who say, I'd like to have an electrified vehicle. I think they're cool. I would, but if you're not of a certain demographic class, you are not stepping into them. If you're,
or in a certain market
that's
too.
absolutely true because of the infrastructure issues and then your use case. Interesting today. Did you see the comments in the press from the head of Daimler Truck, who was talking about he was being asked, Martin Dahlem, he was being asked about Tesla's Semi.
Yes. Yeah.
And he made
not a threat.
Not a threat. He goes, they've got one truck. You need thousands of permutations to address this marketplace.
Right.
And he knows that. And it's true. So likewise, we're going to see, you brought up an issue. If I am a Honda, incredible brand, substantial business, but they're not Toyota from a side standpoint, right? They're not VW, they're not General Motors or Ford even. So I have to invest along with them because I've got markets where I compete head to head in product and volume and for consumers. So, okay, I've got to have product. What's to keep me from picking up the phone saying, hey, China, will you build this product for me? And it's one big fleet deal. And it comes with, and it's a, Chinese vehicle with a Honda badge designed by Honda, engineered by Honda, but, built and in a highly efficient manner using those components.
We've seen that with GM. I mean, we see all that with Buick, Lincoln. I mean, Buick, it's really a Chinese brand for all practical purposes when you think about it, right? The Polestar brand, if they survive, I mean, that's well, let me ask you this: what do you tell dealers? You've probably got quite a few questions from dealers regarding Fisker or VinFast. I mean, they asked me. I was at the Canadian Auto Dealer Summit on stage, and they asked me that question, and I just looked. I'm like, why? Capital is getting much more scarce these days, and these standalone or these startup EV brands have no. I just don't think there's enough runway for them to survive in terms of maintaining the level of capital investment that they need in order to get to the point where they can survive 2, 3, 4, 5 years out. I don't.
And for us, we've been around long enough to remember Malcolm Bricklin and.
Oh yes, yeah, of course, yeah.
And other folks have done things like this, and Henry Fisker has got enough of a track record, that
reputation, background,
He's a brilliant guy and very creative and is high style, but he's not been able to put together the capital and to match up with his product opportunity, and it's so the play itself is going to be difficult in a volume fashion. And the Ocean was designed to be a volume product. Now VinFast is a state-controlled and state-funded business fronted by a very successful private corporation. State-controlled environment that's nurtured it. The products are lower end from a quality standpoint today, and from a style and usability standpoint. But from the dealers I know that have either taking on the franchise or are
like 5 or 6 right now that
are in, some of them are names that you and I have a lot of respect for. They're saying great things about the product, and they're saying great things about the plan, and they're saying great things about the people that are going to be handling North American distribution. And and I think what's attractive about that fresh start with a product that might have some legs is they're going to go in and model what are the more successful franchise operations on a brand by brand basis. So I'll pull the best from that Subaru. I'll get the best of the dealer relationship out of Toyota. I'll do my best as a manufacturer to supply the product, but I am going to be very focused on having a experience-based model that I build. if VinFast is able to do that and then supply the product at the race that they say they can, without having to take them all back for your quality reasons, I think they've got a chance. Would I be putting up the amount of money that's being requested to own a major market? Probably not.
Yeah.
I certainly wouldn't do it in Houston, Dallas, LA, a Raleigh, a Columbus, place like that. Maybe I would.
Yeah. Yeah. Interesting. Yeah. Yeah. Obviously dealers are all focused on getting the next Toyota or Hyundai, Kia deal.
Yeah.
And we've seen that their willingness to invest in these plays at the very, ground level play. So,
that.
Let me
go ahead.
Go ahead. No, I was going to take it in a little bit different direction here, to get back to just the whole financial structure. A big question mark this year is interest rates. Will the Fed won't they cut rates? Right now, it looks like 3 interest rate cuts probably by the end of the year, sometime between June. But I think a lot of that will be determined by the report that comes out next week, the expenditure report, which is what the Fed relies on to determine where we are with inflation. If that comes in a little bit higher, I think this whole idea of rate cuts gets pushed back even further. But what impact does that have, these rates, and does that have on acquisitions?
It's the number one consideration in the marketplace today is affordability. Affordability is affecting what dealers are willing to pay at wholesale for used cars, because they are seeking to fill that void that they have.
Yeah.
And the hottest car in the marketplace is a Chevrolet that's got an MSRP at $22,000. Absolute fastest turning vehicle out there. And it's a great car. It's a great car. So I think that affordability will continue to be an issue for at least another 18 months. Our economists here at Truist are paying very close attention to it and they're really very closely at the how the consumer is behaving. And it's the housing market and the credit card debt condition.
Right.
Credit card debt is not in any better or worse shape than it was in 2019. It's when you look at it, you think, well, people are treating that pretty normally. It has gone up in gross dollars,
but
and some of that's inflation because people are But people are not people are managing their debt, and they're paying their cards. So if they're paying their cards, they're certainly making their car payments, and they're most likely making their house payments or rent payments. So that's bodes well. I think that the consumer is still doing okay, but they're being cautious. We will see a continued shortage of late model used cars, and that will drive value into older used cars. So affordability again is going to continue to be an issue in used vehicles. And if interest rates don't come down, which they will not for another 18 months to the consumer in a significant fashion.
Sure, right. We won't feel the impact of those rate cuts for
third quarter 25, maybe.
Yeah.
So it's the number one issue in retail right now, and that's going to constrain volume for some manufacturers. It was the biggest. If people say, what happened to CDJR? They kind of fell off. Their number just fell off. Well, when Jeep discovered that they're not Land Rover, and that went back, and now they're back producing vehicles at price points that attract that Jeep buyer again, they're going to do fine. Likewise,
they had to figure that out. They went too upscale, and sales have plummeted really.
People. There was a big point made of Nissan putting in up to $1,000 on a Rogue to move their 23 Rogues. Well, there's a lot of that. Then, by the way, it's a beautiful vehicle. By
the way, we all knew it was going to be Nissan that was going to go back.
Oh yeah,
that would be the first to fall in terms of that.
But only because of one common mistake, and this is sad. It's they overbuilt an overpriced vehicle, over-equipped vehicle. Well, and their senior management came out and said, well, hey, everybody wanted the higher equipment, so that's what we planned for. Well, okay, but everybody also knew there was going to be return to normal when the everybody's vehicle started to come up, and you would have to have some deep contented versions of these really attractive cars,
which they didn't have.
They don't have.
Yeah.
And they do in the 24s planned, but not in the 23s. And there's a lot of 23s.
Yeah. So with some of these brands, we have to see some of this inventory wash out and flow through the system.
You still can't buy a hybrid RAV4 well-equipped one for a sticker. You're going to pay over for it.
Oh yeah, sure.
There's all kinds of pockets of vehicles like that.
Right. Of course.
Super attractive and in short supply. And what we did discover during COVID is that consumers will pay what they want to for the vehicle if they want it.
Of course. Despite what the media and all these naysayers complaining about dealers selling over sticker price, they're not complaining when they sell under MSRP.
But those kind of things that we just talked about, just a couple of manufacturers of things. When we're talking to dealers about growth,
right?
We actually publish an internal document here at Truist on a biannual basis, twice a year, rating the brands on their relative value on a banking standpoint. Not necessarily from a market standpoint, but who would you want to bank? And most dealers fall in the middle. Brands fall in the middle, and then there's the whatever it costs, buy it, and the other one say, what, doesn't matter how cheap you can get it, don't. But that's kind of flattened and broadened. There are some, there seems to be a split coming now between the have-nots. As from a brand value standpoint on how lenders look at it.
And this is important because if you buy one of these brands that's quote unquote have not or is getting into that have not territory, then your ability to manage that and grow that is going to become much harder, correct?
Yes. Typically,
the value of that brand is going to just deteriorate, and we've seen that already.
And it will happen. We have also seen them correct themselves.
Yes,
that has happened too. And we've seen some brands that we thought were always going to be middle of the road become more of a premium. Subaru is a fantastic example. Kia is a fantastic example of that happening. But when you say that, that means I have tied up capital in an asset that isn't going to give me recognized value to the marketplace or to my capital market for me to continue to grow from that. So that drives down market value of those products, and it may you may be able to make a ton of money out of that, but just remember that it's not going to have a high intrinsic goodwill value on the other side should things go sideways. And because the brand has demonstrated that it might be likely to go sideways. They might fix it, but it's going to go sideways again.
Yeah.
And we're getting just a real spread in the great ones and the tough ones.
Yeah, it's fascinating when you look at these brands too. It's what they were 30 years ago is what they are today, unless it's a Subaru or a Hyundai or Kia, which have really propelled themselves into another level. But for the most part, what you see is what you get. And, the numbers change year after, from year to year. But I mean, you look at a Nissan, you look at a, FCA or I say FCA, boy, I'm going back to a few years ago, but Chrysler, whatever, even Ford and GM. I mean, these brands are what they are. There's no,
and when the throughput or when the brand slows down over an extended period of time, the balloon is off the rose for whatever reason for the brand.
Yeah.
The manufacturers are less likely to invest in that brand as well. So
Yes.
it's you sink to another level of Dante's Inferno with that brand, and we're seeing some that we're questioning what's going to be the long-term value of this brand, and will the manufacturer maintain it?
Right. Right.
That's nothing new, but
but it's
um,
yeah, it is. Yeah, that's interesting. Man, look, we did when, my early years at Ward's, in the early 2000s, we did a Survivor. When Survivor first started as a TV series, we did a whole series of Survivor for the magazine where we looked at each of the manufacturers and tried to determine, if there was a downturn, which ones would be kicked off the island. Little did we know that downturn was going to come in 2009 in the form of bankruptcy, and I still maintain PE forced bankruptcy. For General Motors and Chrysler at the time. I think the PE firm backing those companies drove a lot of drove the bankruptcy.
Yeah.
There's a lot of reasons, but
it did. There's no question. They needed to get out because it was very dire.
Right. So I guess, but so many of those brands have survived. I mean, we were talking in 2002, 2003 of Honda maybe having to partner with someone because it's a smaller brand or being, being acquired by someone. Well, we see what they're doing. I mean, they're talking to Nissan, General Motors, who's it, Samsung. I mean, they're trying all these different plays on the EV side. We've seen consolidation come and go with a lot of these brands. Ford did the whole international consolidation for a while and then pulled out. General Motors, same thing. But so there seems to be an ebb and flow, but sometimes you just it's nothing that we haven't seen before. But again, going back to what I said earlier, the whole EV play is something that I think we have to, we just don't know the answers to. So
when we have that kind of becomes a timing issue on an exit as well, Cliff.
Yes.
If you've had a good run with a middle of the road brand, don't expect even though you're good at it, don't expect someone else to feel as comfortable about being good at that brand as you are.
Right.
And if that's your sole brand, you need to be realistic about what really is going to be the value and and do your best to be smart about the timing on it.
Right.
It's my number one advice to dealers that are looking to sell is not how are you going to spend your time personally. It's more who would you want to own your business?
Right.
And I have to tell you, 95% of every private transaction that we're involved with, the economics drive the decision. There's a value that's attainable. It sounds attractive to the seller. It's attractive enough to the buyer. But when you get down to it, the seller is driven 95% by those economics. But 5% of the deal is emotion. And all the voting stock is in that 5%.
Right.
And that is the first thing you do. You go and you talk to the emotional part of it is, am I really willing to part for this? Or am I going to just, have unreasonable expectations for a price and waste my time?
Yeah, sure.
Because I don't really want to.
Which we see a lot of that. I'm sure.
We do.
Last question, any big surprises coming down the pike this year, do you think?
I think there's going to be a couple of institutional investors make some not big plays, but they're kind of toe in the water plays because they like the temperature, they like the depth, and they're going to go for a swim. And the Jordan company's experience with RFJ was an awesome model.
Yes, right.
Haven't been very many failures in that model. Typically it's somebody just does something stupid. If it
Sure.
So
Yeah.
if you go in with your eyes wide open and with the right operating team, I think some institutional investors are going to discover it's a great place to be an investor. And we're going to see a couple of really nice ones in the next 12 months come in that are going to make a splash over the next 5 years.
Okay. Well, that's good. That's good to hear. It keeps us busy, writing and providing analysis of that. But JT, thank you so much. I know we could go on for much longer.
Yeah, we can.
But I think we're bumping up about 45 minutes now. So, but thank you so much. We'll see you. We'll see you at around the industry conferences. And if you are in the market selling or looking to buy, Truist is a great option. And JT knows his stuff. He's been around for a long time. In fact, he was one of the first employees at Lexus when they first launched. And he's a former dealer also, and he's been around and has been part of so many of these deals that we read about in the headlines, these monster deals. He's one of the guys behind the scenes helping drive the financing and putting those plays together. So thank you so much for sharing your expertise and time with us, JT.
Appreciate you, Cliff. Thank you so much, and we'll see you soon.
Yes, great. Take care.
Thanks, man.